Hello, and thanks for watching the ETF Show. Market uncertainty, policy shifts, and diverging economic growth across world markets has led to investors rebalancing equity portfolios to manage risk and capture emerging opportunities. Joining us today is Mark Carver, Managing Director and Global Head of Equity Solutions at MSCI.
Great to be here. Nice to see you, Jenna.
So, as you heard in my opening, markets have been anything but dull this year. But how have equity investors fared?
Well, equity investors generally have done quite well this year. And last time we spoke, we talked about the strength of global investing or the markets outside the U.S., particularly developed markets outside the U.S. like Europe. And through the end of Q2 and even through last evening, we see that pattern generally continue. Equity investors have done really well. MSCI ACWI's up almost 12% year to date, and we continue to see strength in non-U.S. markets. MSCI Europe's up over 24%. Developed markets outside the U.S. We look at MSCI World ex-USA, for example, is up over 19%, while the U.S. market's up a little over 11%. So you see that continued strength in non-U.S. markets, but we do start to see some cracks in that foundation, if you will. In fact, if we look at the last 3 months, for example, that's kind of the period where we had Liberation Day. We had this incredible volatility around Liberation Day. After that sort of settled and investors sort of took a deep breath from that point to today, so let's say the last 3 months, we see real strength in the U.S. market. It surged up over 20% over that 3-month period. That's about 900 basis points better than the developed markets outside the U.S. And so still the similar story that we talked about, good story for global equity investors, really good story for developed markets investors. And the U.S. story has been, sort of shifting throughout the year.
Certainly, that's interesting. And to build on this a bit, you spend a lot of time with clients and investors, Mark. What are you hearing from them right now?
Well, the biggest thing that we're hearing from clients is actually a big difference in what we heard 6 months ago. So as you know, we did a survey at the end of last year. We went out and talked to investors. These were everything from wealth advisors to big sovereign wealth funds and all things in between. And generally what we were hearing at the start of the year was this belief that American exceptionalism would continue, built on the foundation of technological innovation, friendly policy. And today, we're not hearing that. We're hearing actually a lot about investors rebalancing their global equity portfolios outside of the U.S. into non-U.S. equities. Now, this isn't done wholesale, meaning a stark move out of U.S. to non-U.S. equities, but we're starting to see rebalancing and shifts towards allocating more money outside the U.S. The fact of the matter is, a lot of your audience, they invest in ETFs. We're seeing that in U.S. ETF flows. In fact, in the U.S. market, non-U.S. equities had $26 billion of positive inflows to non-U.S. equity-linked ETFs in June alone. Looking at a report from State Street Investment Management, for example, they note that's the second best period in history, which I didn't know. But that's tells you that the things that we're hearing are also turning into the trades that investors are putting on. And part of that is because of valuation concerns. Part of that is for diversification reasons. Some of it is around sentiment given the geopolitical dynamics and the policy dynamics that are happening in the world. And as a result, investors are reallocating. From a valuation standpoint, we see at the end of June, the U.S. market continues to trade at the highest multiples. It trades at over 22 times forward earnings, in contrast to developed markets trading at about 14 times forward earnings. Why do people care about that? Well, the U.S. market trades at almost a 20% premium on a forward basis to its 10-year average, while developed markets outside the U.S. trade much closer to their 10-year average. And so as a result, investors have looked at those valuation dynamics and said, is it time, given everything that's going on, to reallocate money to non-U.S. equities? And in fact, investors seem to be voting that, both in what they're telling us and then what we see in the ETF data.
This theme of global diversification is one that we're definitely hearing a lot from advisors as well on our end. Now, finally, Mark, your expertise or specialty has been style or factor investing. What did the performance of styles or factors tell us about the equity markets?
Yeah, I think it's a great question, and it's a sort of a special lens of the world, if you will. And what the first thing I note when I look at the world through the lens of factors or performance through the lens of factors is that there's uncertainty. Now, why do I say that? When I look at our factor models, your clients, your listeners may think of that as pure factors, right? The pure factor or the factor models tell us that there's investor uncertainty based on the evidence that both in the US and globally, the best performing factor year to date has been short-term reversal. Short-term reversal is about mean reversion. The fact is when people are trading mean reversion, it often means that they don't have a lot of confidence in the way markets might trade on a go-forward basis. Now, we also see momentum, value performing positively in both the global and the US factor models. Now, things that might even be even more surprising to your listeners and to the audience is the performance of quality dimensions. I listen to pundits, I listen to media outlets, and often hear my peers around the industry talking about this market as one that would favor quality. But when we look at the factor models, we see a slightly different picture. Things like high leverage, earnings variability, those factors, which are generally things that a quality investor would want: low leverage, low earnings variability. We see leverage and earnings variability as positive factors year to date. By contrast, profitability and earnings quality are negative year to date. You can see that when I look at factor indexes. So, for example, the best performing factors in our factor index series in MSCI USA have been momentum enhanced value, has been very strong. And that might surprise people when we look at quality. Quality is underperformed. Some people have justified it because the valuations of quality stocks coming into the year might have felt stretched to some. But that evidence in the factor models, where the sort of anti-quality dimensions have done better than the higher quality dimensions, we can see that indicated in the indexes. Not surprising, given what I said at the beginning in terms of the way global investing has panned out this year, we see strength in factor index performance when we look outside the US. So World ex-USA, all of our factor indexes, so think about momentum, equal weight, dividends, enhanced value, et cetera, have outperformed MSCI World ex-USA. We see similar things in Europe. There, we also, like in the US, see quality as relatively weak. So I think that level of uncertainty, the dynamics going on across diverging central bank policies, diverging economic strength across the globe, and obviously with some trade uncertainty, that's given investors a little bit of anxiety, and that anxiety is priced into markets.
Certainly. Well, Mark, really great to have you back with us. Thank you so much, and we appreciate everyone out there watching. Once again, that was Mark Carver, Managing Director and Global Head of Equity Solutions at MSCI. And I'm your host, Jenna Dagenhart with Asset TV.